So, assume the bond has 14 years of maturity. Now what happens over time? Okay? So what does this mean? Nice graph, I like the colors. What does that graph tell you? It's years of maturity on the horizontal axis and bond value on the vertical axis. Let me first ask you, what the bond that's in the red, is that a premium bond or a discount bond? It's a premium bond, and the one below in Chartreuse, I think somebody called it last year, is a discount bond. So the bond value, that's the price that the bond is trading at today. If interest rates stayed the same at 10%, what happens? What line is there? The black line, the M. Things are simple. Interest rates don't change. It always stays $1,000. If interest rates go up, then we head on down to the Chartreuse line, and if interest rates go down, then we head up to the premium bond line. So what's happening as we go down? Let's look at the premium bond. What's happening as we go from the left to the right? As we go from 14 years down to 0 years? What's happening?
The closer it gets to maturity, the closer it's equals the value of our value.
Right. So what happens at year 0? What is year 0?
Maturity.
The day the bond matures. And what do you get on the day the bond matures? The $1,000. You get the par value. So what this is telling you is that premium bonds, they start whatever their value is today. As they approach maturity, get closer and closer to maturity, they go down in price until the day they mature, you get the $1,000, which is, there is no time lag anymore. The 1,000 is 1,000. Discount bond, on the other hand, is the opposite. The discount bond, essentially, as you get closer and closer to maturity, the value of the bond goes up until the day the bond matures, when you get the $1,000. So that's why it slopes up gradually. So what do we call going down is that red? I guess going down the premium bond line. What's happening every year? Capital loss. So premium bond holders have a capital loss every year. But what else do they have compared to a discount bond? Yeah, they have a higher interest rate. So premium bond holders have got capital losses every year, but they have higher interest rate because that's how they became premium bonds. Discount bonds, on the other hand, have capital what every year? Capital gain every year, but they have a lower interest rate. So it's a complicated mix. Premium bonds and discount bonds are complicated mixes of capital gains and current yields, interest yields. And it's the exact opposite for one. The premium bond has got a capital loss every year, but a higher interest yield. Discount bond has got a capital loss every year, but a lower interest rate. Capital gain every year, but a lower interest rate. Okay.
So then, does that imply that for the premium bond, that if you were trying to get money, that you should sell it early, and if it in a discount bond, then you should sell it later to try to, since it.
That's a very good question, and essentially one is that, yes, if you can guess where interest rates are going better than anybody, that's a good strategy. Secondly, there are all kinds of tax effects. A lot of the buying and selling of bonds is when do we want to take the capital loss? So for example, we may be in year 10, and we know that we're going to have a huge profit in year 5. So we can use some of the capital loss if we sell the bonds that year to offset that profit. So there's no cardinal rule. It really depends on all kinds of different factors, including tax status. So, to summarize, at the day the bond is issued, the bond's value equals its par value. At maturity, the bond's value equals the par value. The value of premium bond goes down over time The value of discount bond goes up over time. So the return on any bond, if you buy a bond today and you sell it a year from today, it depends on what kind of a bond it is, a premium bond or a discount bond. But it'll be a complicated mix of a capital gain or loss plus an interest yield. So how do we define those? Well, when you look at the financial pages, you can see current yields, capital gains yield on different kinds of bonds. So the current yield is simply what is the coupon payment you're going to get. So for a 10% bond, it's $100 over whatever the price is. That's the current yield. That's the amount of return you get if you bought the bond today. And the capital gains yield is the change in price from the beginning of the year to the end of the year. So let's just go through it quickly. And the total return on the bond is the sum of those two things. So let's go through a quick arithmetic example. So we got a bond now selling at 10% interest, and interest rates go down to 5%. What will happen? Well, we calculated a minute ago that the value of the bond would go up to $14.95. So it would be a capital gain of $495. $14.95 minus the $1,000, which is $495 over $1,000. So a capital gain of 49.5%. This is an extreme example, as I said. You'd never get these kinds of big interest rate changes in the real world, but it's illustrating the point. The current yield of $100 over $1,000 is 10%. So that yield in that year would be 59.5%. So if you are able to predict that interest rates are going down and no one else can, you can make out like a bandit in the bond market. This time, now let's say that, so we issued the bond at 10%, interest rates dropped to 5%. Okay, now it's a year later, and the market is settled. What do we find? Well, the current yield now is $100 over the new price, which is $14.95, and that's 6.7%. But the capital loss, because remember it's a premium bond, and the value of the bond is going down over time, is going to be the $25. When we add those two in together, you get 5%. Why is there 5%? What is that? Why is it 5?
That's what the market's offering.
That's what the market is demanding on that bond right now. So yes, if you can predict interest rates better than anybody can, you can make a big capital gain or loss in 1 year. But then after the bonds have resell the prices, essentially the rate of return you'll get on that bond will be the same as everybody else's bonds. So for a premium bond, this is a good example of how you've got a higher rate of interest than what's going on in the market. What's going on in the market is 5%, you're getting 6.7%. But you're also getting a capital loss of 1.7. The net result is the same rate of interest as what's going on in the market. So let's do the other one and then I'll pause. Maybe I should pause. Does everybody understand the arithmetic here? This is complicated stuff. Getting your head around the relationship between bond prices and interest rates is sometimes challenging. So if you have any questions, I'm happy to answer them. Okay, let's look quickly at a practical example. This is a report from last week. Hospital Finance, HFA Partners is a great source of information about bond prices. Can everybody see those numbers or not? Can you see Norton Healthcare? What do you notice? Is Norton Healthcare a premium bond or a discount bond? And this is last week. Who said? Did you say that? Okay, why do you say that?
Because their coupon rate's lower than what their current rate is.
Exactly. The yield on this bond is 6%. The coupon rate is 5.75. We'll talk more about yield in a second. The yield says that interest rates in the economy have done what?
Increase.
So, and the coupon rate is, so if I had the price of Norton bonds, what will have happened to Norton's bonds in the last, what will it be selling at, discount or premium? Above 1,000 or below 1,000?
A year later or now?
Right now, if I had the prices of Norton bonds,
Below.
it's a discount bond. Interest rates have gone up. The market's paying 6% on a bond of that duration and that risk. The coupon yield is only 5.75%. So the price of Norton has got to be selling below $1,000. Look at the next line, Providence. What's happening with Providence?
Market.
Is it a premium bond or discount bond? What's happened to interest rates since Providence bonds were issued?
Gone down.
So what's happened to its price? It's gone up. So it is a premium bond. So Norton is a discount bond, Providence is a premium bond. And yet they're right beside each other on the same line. How can that be? How can you have two bonds selling, one selling for a premium, one selling for a discount in the market at the same time? Why aren't they all premium? Why aren't they all discount? What's going on? There's another column on that table that answers my question. Maturity. Who said that? Tell me why you say that. What does that column tell you?
The closer you are to maturity, the more likely that your bond is going to be closer to the par value.
Yes, and what does it also tell you about when the bond was issued? I mean, most of these bonds are going to be 20, 25-year bonds. So what do you notice about the difference between Providence and Norton?
Providence was issued in the late 90s when the economy was soaring.
Yeah. But they were issued in different eras when interest rates were different. So Norton was issued in an era where there were lower interest rates. Providence, the vice versa. This is why you can have bonds, premium discount, trading in the same market, because they're issued at different times, they've all got different interest rates, and the interest rates reflect the era as well as all the individual characteristics of the bonds of the organization.
What is the date column?
That's last week.
Oh, that's just when these numbers were.
Yeah, that's the date. That's the last day of these bonds were traded.
Okay.
You're saying again which was which? The one that has the yield higher now.
Norton has a coupon of 5.75. The yield is 6%. That tells us that interest rates have gone up. So it'll be selling at a discount. Providence has got a coupon that's greater than the yield, which tells us that interest rates now are lower than when the bond was originally issued. So it will be selling at a premium.
Can I ask a question about that slide? Where did
Which
you
one?
get the negative 25 from?
If you calculate the value of the bond at year 15 and you subtract from the value of the bond at year 14, the difference is $25. So it would be the $14.95. It would be $14.70 because there's a capital loss every year. Okay, so yield to maturity now, what you will see when you go to the markets, you'll see yield to maturity on the bond. And the yield to maturity is essentially the expected rate of return on the bond, holding default, risk, and so on constant. Mathematically, it's the value that makes the cash flows of the bond equal to the bond's price. So, in fact, what we're doing here is simply saying we have a bond with these cash flows, it's selling for this price, what is the effective rate of return on that bond. And what we do is we can do two things here. We can use the IRR formula, which essentially is we got the bond selling for $14.94. We have all those coupon payments of $100, and then we have the principal repayment. We highlight the IRR and those cells using the IRR formula, then you'll get 5%, which, surprise, surprise, that's the going rate in the market. We can also use the rate formula, which essentially says if the bond has 14 payments left, it's selling for $14.94 in the market, has a $100 annual coupon, and the maturity value of the bond is $1,000, then we can use the rate formula to give us what the yield to maturity on that bond is. So instead of having to go through all the complications, the formulas that we went through a few minutes ago, or list out all the different payments, we can simply use the rate formula to calculate the yield to maturity. So if the price of the bond was selling right now at $713.78, and interest rates in the market, and we know that the coupon payment is $100, the price is $713, there's 14 payments left. And essentially, we can use the rate formula to calculate the yield to maturity. So why is this important? It's because we don't really observe directly what investors' required rate of return on a particular bond is. What we do observe is the trading, the price changes. So this data can all be observed for UNC bonds, for Duke bonds, whatever. We know how many payments a particular bond has left. We know what it's selling for in the market because we just look on the website and see what it's trading at. We know what the coupon payment, because that's in the contract. And so we can use the rate formula to say, well, if we bought this bond today, we would be getting a 15% yield to maturity. And the yield to maturity is exactly what it says. It's the yield on the bond, the rate of return on the bond, from today to the day the bond matures. So yield to maturity is really the number you see out in the real world. That's what you see on websites, that's what you see on bond pricing. Yield to call. So as we talked about a few minutes ago about call, if some bonds are callable. And what is callable? If a bond is callable, how will investors view that? Do I care as an investor whether a bond is callable or not?
Yes.
Why?
You can lose your potential investment if they call it early.
Right. So you may have a complicated portfolio all set out, timed well, but if you've got a callable bond in there, that represents a source of risk. You face the risk that the management of the organization that issued the bond will call the bond unexpectedly, and you're left having to reinvest the bond at what rate of interest? A lower rate of interest, because only an irrational manager will call a bond if interest rates were higher. They will only call bonds if they're lower interest rates. So if interest rates are lower and the bond is called, you're going to get your $1,000 back, but you're going to immediately have to reinvest it at a lower rate of interest. Therefore, it's a source of financial risk to investors. As a result, most bonds that are callable will have call premiums built into them. So that instead of getting your $1,000 back, you get the $1,000 back plus a call premium. And here it's $100. So you can see 8.5, it's $1,100. Meaning that there's a $1,000 principal plus it's $100 for the call premium. So in fact, on this bond, the yield to call would be 21.1%. That would be the yield to maturity if it was called and you got that $1,100. Bonds are paid semi-annually. Almost all bonds have semi-annual coupons. So as we talked about when we talked about time value money, we have to make some adjustments to the formula, the rate formula, PV formula, and so on, to account for the fact that they are semi-annual. And it's quite simple, really. The interest payment is half the annual amount. You just take the coupon rate on the bond, and you divide it by 2. But they're paid twice as often, so you multiply the number of periods by 2. So that's all.